David Kostin, Goldman Sachs today lifts his S&P 500 year-end target 4,500 as the narrow year-to-date rally broadens out beyond mega caps. Are you coming around? Are you coming around to a more bullish perspective?
Well, my positioning has come around to some extent. I mentioned a week or so ago, I bought Deere. Microsoft I put on a pretty big position. I did sell some treasuries, small part of treasuries that are actually coming due in September. Look, I think I said at some point last week that 4,200, if it was breached, to become, instead of resistance, can become support, and possibly that's true. I mean, it's undeniable that that people want to put money in the market, despite positioning from hedge funds being at '07 lows, meaning in terms of bad positioning, think the market's going to go down.
Never, as you know, they're never the greatest indicator.
They're not. Nothing's an indicator, and this time is different, and every time's different. So the old, saying it's never any different, it's always different. It's different because of the factors that get you to that different point. The ending may be the same, but look, I think that we have avoided, for now, Armageddon, at least, but we still have not seen the impact of the Fed tightening policy. Will we ever see it at its maximum? I don't think so. As far as the market goes, as far as the economy goes, it's a different story. But you've really separated things from, what's happening with the economy, which is slow.
Well,
it's undeniable.
Mark Zandi was tweeting about that, which I thought was really interesting. He said, quote, the odds that a downturn is dead ahead are receding. And in fact, that this time actually might be different. Got a lot of excess savings, number one. Labor hoarding by business, number two. Low leverage, number three. So the kind of cataclysmic scenario that many painted, not saying that you said it was going to be a cataclysmic event, but nonetheless, this idea Fed goes 500 basis points. The economy and the market can't possibly handle that. But here we are. And maybe the people who are using their forecasts are using outdated methodology. We had a once in 100 year event in the pandemic. We flooded the zone with more cash than we can ever remember. People sat on that cash because they couldn't do anything with it. They didn't lose their jobs because nobody wanted to fire people during the pandemic. So people have jobs. The labor market's strong. People are still sitting on savings.
Right, but
where's the end?
No
is near.
disagreement there.
Where?
It doesn't mean that it's not going to be felt ultimately. Right? You may have delayed the impact. Now, I was never looking for a depression. I was looking for a slowing economy. We've got a slowing economy. I was looking for a recession. We may still get a recession. The question is, what's different as far as the market goes? And what's different as far as the market goes, as I've said repeatedly, you've got a different class of investors, a different type of investor. The people, the OGs, they're retired, they're spending their money, they're off in their yachts. The new ones that are coming up are looking at 30, 40 years, and they're saying, you know what? In my lifetime, my investing lifetime, as long as I've been aware of the market, every time the market's gone down, it's gone right back up. That's not been wrong. Any stock you buy, you say, to your book, right? Buy high, sell high. Anytime you buy it high,
Dalio's an OG.
High.
Right? Yeah. He's an OG. He said just a few moments ago, I see a financial crisis ahead. He's worrying about the debt bomb and
I don't think that's off the table.
All this other stuff.
I do not think that's off the table. Look, commercial real estate, you're going to see $1 trillion. It's got to be refinanced not that far away from now. So to think that, okay, hey, we had Silicon Valley Bank, we had First Republic Bank, man, that's the blow up. Oh, wait, no other banks really blew up. Nothing's happened. No, it's because the leases haven't ended. People haven't walked away from their leases. That's going to happen. The question is, can we absorb it?
I understand, but Bryn, we're 20% off of the low, as we said. Steve Sutmeyer, Bank of America's technical strategist, says cyclical rallies in excess of 20% can persist. He goes back to 29. These cyclical bull markets have lasted 33.6 months on average, with an average return of 114%. So are we on to something here? Have we traveled too far from the depths of where we were to turn back now?
I think that this technical bull market, whether it's cyclical or secular, gets really tough for the bears who've been sitting on the sidelines. Scott, if you go back to 1946, so a treasure trove of data, when the S&P is 20% off its lows, the 12-month average return going forward is over 16.5%. and 85% of the time the market was positive. Now, there was 2 exceptions in like 1948 and 2001. But if I'm in Vegas and I have something with 85% probability, I'm probably going to bet on that. And so I just think this market in the short term, because I think what Joe said is really important about inflation will have a 3 handle by August. That is very bullish. The Fed tomorrow, as Roger Ferguson said, does a hawkish pause.